Now we're getting to the exciting stuff. We've already talked about getting pre-qualified for loan and the things needed to get that accomplished. We've talked about how, picking out a house, so on and so forth. Now we're going to talk about picking out a mortgage, which is actually kind of entertaining in its own right. What we're going to be looking at is various types to include ARM loans or adjustable rate mortgages and fixed rate mortgages. Now, you're going to have questions. Feel free after this to go back and email me at localmortgageguy@gmail.com, or you can call me 251-616-0005, or you can text me. Again, I understand that you're going to have questions, or you can contact your other local mortgage people. But again, Brian, your local mortgage guy, and I'm here to help. Let's get started on the videos now. And remember, like, save, and share all these videos because it helps others also. So thank you. Get the right mortgage for your situation. When it comes to home financing, there's no one-size-fits-all approach. There are a variety of loan programs available to meet your specific financial situation, and you should talk to your lender about which one is right for you. What type of loan is right for you? There are two different types of loan products. There's fixed rate versus adjustable rate mortgages, better known as ARMs. Fixed rate. A fixed rate loan provides a fixed rate throughout the life of the loan, meaning the rate will not change 10, 20, or 30 years from now. A fixed rate loan may be the better choice if you want stable payments and plan to live in your home long term. An ARM, or adjustable rate mortgage. The interest rate will fluctuate over time. ARMs can either go up or down, which will affect your monthly payment. An ARM may be a good option if you plan to live in your home for a few years. Loan types. Conventional versus government sponsored. Conventional loans. With a conventional loan, the lender assumes the risk for lending you money. As a result, conventional loans have more stringent credit requirements and higher down payment requirements. Conforming loans are those that adhere to loan limits set by the Federal Housing Finance Administration. For 2019, that limit in most counties throughout the U.S. is $484,350. That number again, $484,350. Jumbo loans are those loans that exceed the conforming loan limits. Interest rates are usually a little higher on jumbo loans because they represent a greater risk to the lender. They may be also stricter credit standards and underwriting requirements. Government-sponsored loans. With a government-sponsored loan, the government backs the loan or assumes the risk for lending the money. They typically have lower credit and down payment requirements to make it easier for you to obtain a mortgage. FHA, Federal Home Administration or FHA loans, allow you to purchase a home with as little as 3.5% down. Because of the low down payment, borrowers are required to pay mortgage insurance premium or MIP on top of the monthly payment. VA. Backed by the U.S. Department of Veterans Affairs, VA loans require no down payment, it does 100% financing, and no mortgage insurance. They are available to eligible veterans, active duty members, reservists, National Guard members, and surviving spouses. USDA. Backed by the U.S. Department of Agriculture, USDA loans are available for homes in eligible rural areas. While USDA loans do not require a down payment, they do require mortgage insurance. Paperwork you may need for the loan application. When it comes time to submit your loan application, your lender will ask you for a lot of different documents. Use this checklist to help you get your paperwork in order. First off, we need your tax returns, and that's going to be the two most current years. That is to include your W-2s and or 1099s, and if you own your own business, your K-1s. Your 2 months most recent bank statements, 30 days pay stubs, a 2-year at least residence history, a list of all your debts such as credit cards, car loans, student loans, a list of all your other assets including investment and retirement accounts. Additional documents may be required. Check with your loan officer for a complete and final list. Application process. Once you've submitted your loan application, it triggers a series of events that must take place before you get your loan approval. Number 1, the loan estimate. Within 3 days of submitting your application, your lender must provide you with a loan estimate, or an LE, which is a form that outlines the details of your loan that you've applied for. This is not a loan approval, but rather a summary of what your loan will look like should you decide to move forward. Processing. If you decide to move forward, the application will then get turned over to the processor, who reviews the loan file to make sure all necessary paperwork is present. The processor will work with your loan officer to collect all the documentation needed for your loan. During the processing stage, an appraisal will be ordered on your prospective property to ensure that the home is worth the amount of money of the loan for which you have applied. Appraisal. During the appraisal process, a licensed third party will evaluate the property in order to determine the value of the home. The appraiser will look at the home's condition, age, and size. He or she will compare the property to other home sales in the neighborhood and consider the replacement cost of the property. Underwriting. Once the processor has compiled a complete loan file, i.e. the application and all supporting documents, the underwriter reviews the application in detail to make the final decision to approve or deny your mortgage loan. This includes reviewing your employment history, credit history, and the appraisal report. The underwriter also ensures your mortgage meets current loan document guidelines. If the underwriter requests further documentation, you will be required to provide it before going forward. This happens often, so don't be alarmed if you're asked to provide additional documentation. Loan commitment and approval. If the underwriter approves your application, you'll receive what's called a loan commitment letter, which confirms your approval for the loan. This document outlines the detail of your loan, including the amount being borrowed, the interest rate, and the term of repayment period. Once you've received your loan commitment, the next step in the process is closing on your home. What not to do during the loan process. Once you've been cleared to close, you may want to go out and celebrate by buying new furniture or appliances, but doing so could jeopardize your loan approval. Here are some steps you should avoid taking until you've closed on your home. That's important, until you've closed on your home. Don't apply for credit, such as new credit card, car loan, or financing for furniture or appliances. Don't make major purchases. Don't liquidate funds. Don't make large deposits. Don't switch jobs. All these could impact your final closing, even if you've already been approved. And as a matter of fact, it could actually cause your loan to be canceled. Thank you for joining me on this video. I hope you're enjoying the series. Please hit like, share, and subscribe. Again, like, share, and subscribe. This helps more people discover info on how to buy a home. Find us on the web at moneyformyhome.com. And again, that's all spelled out, moneyformyhome.com. You can call us at 251-616-0005 or email, and again, all spelled out, localmortgageguy@gmail.com. Again, that's localmortgageguy@gmail.com. Thank you